Have you ever heard people talking about the next big IPO or seen companies announcing their IPOs and felt lost? Wondered what an IPO is and what all the buzz is about? Well, today we're going to break it all down. In this video, we'll learn 6 things. What is an IPO? Why do companies go for an IPO? The various types of IPOs, who invests in an IPO and why, key terms related to IPOs, and the process of an IPO. Let's start. First things first, what exactly is an IPO? Well, IPO stands for Initial Public Offering. It's basically the first time a company offers its shares to the public to raise money. Before an IPO, a company is privately owned, meaning its shares are not available to the general public like you and me. But once it goes through an IPO, anyone, yes, even you, can buy a piece of that company. Think of an IPO as a way for a company to open up a new source of finance. The money raised can help the business expand, buy new assets, pay off debts, and more. After an IPO, the company goes from being privately owned to being publicly traded on the stock market. This means that the company's shares are now available to be traded by the public through a broker like Zerodha. Now, there are 2 markets at play here. The issuing company and the buyers during the IPO make up the primary market, and any further trade takes place in the secondary market. The primary market is where you can invest in the company by applying to its IPO. In case you cannot get an allotment, then the secondary market is where you and everyone else can engage in further trading and investing. So why does a company decide to go public in the first place? Well, the most obvious reason is to raise funds. But there's more to it than just that. So let's take a look at the reasons that a company might opt for an IPO. First, no repayment obligations. Unlike loans, the money raised from an IPO does not need to be paid back. Shareholders can sell their shares whenever they want without the company having to worry about repaying the money. Second, access to a larger pool of funds. When a company goes public, it taps into a much larger pool of investors, meaning a much larger pool of funds. It can now invest in growth and expansion without having to rely on the promoters for money. Third, improved visibility. Going public puts a company on the map. It gets more media attention, more investor interest, and overall higher visibility and transparency. This increased visibility attracts institutional investors, analysts, and helps the company's market presence grow. Fourth, collateral for loans. Listed shares are accepted as collateral by most banks and financial institutions. This means the company can get loans without putting its operational assets at risk. Fifth, exit opportunities for early investors. An IPO allows early investors like pre-seed, seed, angel, and other investors to liquidate their investments in the company. These investors fund the company before they're listed and expect to grow their money by selling their stakes when the company goes public. An IPO provides an opportunity to these investors to make an exit from the company unless they want to stay invested. And finally, reward employees. By listing its shares in an IPO, a company gives its employees the power to exercise stock options or other forms of equity-based compensation. Stock options allow employees to buy shares of the company at a fixed price when the shares are listed. So an IPO is like a big step forward for a company, opening up new opportunities for growth and development. Now let's talk about the different types of IPOs. There are mainly 2 types. First, there's the book building offering. In this type, the company decides on a price range for its shares, known as the price band. Investors then bid within this range, stating how many shares they want to buy and at what price. Once all bids are in, the company decides the final price, called the cutoff price, based on the bids. If you bid at or above this price, you get the shares. If not, your bid is rejected. The second type of IPO is the fixed price offering. In a fixed price IPO, the company sets a specific price for its shares and investors can buy them at that price. There's no bidding involved, making it a relatively simpler process. So depending on how the company wants to price its shares, it will choose between these 2 methods. Now that we've understood why companies go for an IPO, let's flip the coin. Why do investors invest in an IPO and who can invest in an IPO? Well, pretty much anyone. There are retail investors like you and me, institutional investors like banks and mutual funds, high net worth individuals or HNIs, and much more. And investing in an IPO can offer multiple benefits. Number 1, early investment opportunity. You get the chance to invest in a company right from the beginning of its journey in the public markets. If the company does well, your shares can grow significantly in value. Number 2, potential for high returns. IPOs can sometimes offer significant listing gains where the share price on the first day of trading is much higher than the IPO price. So whether you're a seasoned investor or just starting out, IPOs can offer some exciting opportunities. Now let's go over some key terms you'll often hear when people talk about IPOs. Number 1, issuer. The company that offers its shares to the public in the IPO is called the issuer. Number 2, underwriters. Underwriters are financial institutions that help the company with the IPO process, including pricing and selling the shares. They also step in if the IPO doesn't get enough buyers. Number 3, price band. Price band is the range within which investors can bid for shares in a book-building IPO. Number 4, draft red herring prospectus or DRHP. DRHP is a preliminary document filed by the company outlining the terms of the IPO, its purpose, and the company's financials. Number 5, oversubscription. When more shares are applied for than are available, the IPO is said to be oversubscribed. Number 6, undersubscription. The opposite of oversubscription, when fewer shares are applied for than are available. Number 7, flipping. This is when investors sell their shares soon after the IPO to make quick profits. Understanding these terms will help you navigate the IPO process more confidently. Now that we've learned a bit about IPOs, one question remains: how exactly does an IPO happen? Here's a step-by-step breakdown. 1. It all starts when the company decides to go public and hires underwriters like investment bankers or other financial institutions to help with the process. 2. The company then files a draft red herring prospectus or a DRHP with SEBI, India's securities regulator, explaining the details of the IPO. The DRHP contains the terms of the IPO and information about the company's financial performance. It helps the public decide whether or not they want to invest in the company. 3. Next, the company chooses which stock exchange it wants to list its shares on: the Bombay Stock Exchange, BSE, the National Stock Exchange, NSE, or both. 4. The company then promotes the IPO to potential investors through roadshows and other marketing activities. 5. Now, in the case of a book-building IPO, this is when the bidding window opens for investors to place their bids. 6. Once the bidding ends, the final price is determined and shares are allocated to investors who meet the cutoff price. The price of the shares is set with the help of the underwriters. If the IPO is undersubscribed, the underwriters may step in to buy the unsold shares to help the company meet its capital raising targets. In case of an oversubscription, the shares may be allotted on a lottery or pro rata basis. Under pro rata allotment, the number of shares allotted to each investor is reduced to ensure that all applicants receive some shares. 8. Now the shares are listed on the stock exchange and trading begins. Investors can now buy and sell these shares on the open market. 9. Lastly, after the IPO, the company has to meet certain reporting and disclosure requirements to maintain its listing. And that's how an IPO happens. It's a complex process, but it's also important for companies looking to grow and expand. So there you have it, an overview of what an IPO is, why companies go for it, the types of IPOs, and how the whole process works. IPOs can be a great opportunity for both companies and investors, but it's important to do your research and understand the risks involved. You can check out and apply for upcoming IPOs on Kite by Zerodha. To learn how to apply for upcoming IPOs at Zerodha, check out the link in the description. And for more such information about the stock markets and finance, check out Varsity by Zerodha. You can find the link to Varsity in the description box as well.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.